Hello traders, this is Philemon here from FinTrader Cabin. In today's video, I would like to show you how to trade price action with supporting factors. Looking at this chart, the 4-hour chart here on USD CAD Canadian dollar, I would just like to show you exactly how to spot price action signals that have enough supporting factor or confluence to trade the market. So if we are looking at the USD CAD here, we are seeing a nice down move, makes a lower low, lower high, and then followed by another lower low, and then retraces back and then moves down, okay, and then it keeps going up. So what we are spotting here is, so we are now, what we are spotting here is those zones, those support and resistance zones. We are spotting those support and resistance zones. Those are the zones that we are looking to enter the market in. Okay, so those are support and resistance zones that we'll be spotting as the trend moves down. So once you spot that, because normally the market will make, as the market makes there's lower lows and lower highs, or higher lows, makes that lower low and that lower high, okay, and that lower low. So as market moves, ebbs and flows, okay, as it continues to with the trend, and as you spot those levels now on the market, those support levels that have actually drawn before. So what you normally do, how to trade them, is this is how you actually trade them. So when you first spot that lower low, okay, so meaning that that's the previous, on an uptrend, that's the previous lower high. So that is now broken, as market was actually moving now, makes that lower high, goes up, lower high, low, makes a lower high and lower low, I mean a higher high and a higher low. Okay, you see now the trend there has actually returned to a change, to a shifted to a downtrend, because now that higher low, okay, is now now this, I mean this lower low, it's now lower than that higher low. Okay, so now this is how do you enter a trade. To enter a trade, after spotting that, okay, after spotting that, there are 2 points on a chart that you can enter a trade. You can either, as the market flows that way, you can either enter a trade at that support, I mean at that resistance level downwards, or you can enter a trade at the break of that resistance level downwards. But what's the difference between these two trades? Okay, so the first trade, you actually have a tighter stop loss, while for the second trade you actually have a wider stop. Okay, so let's take a look at entering on the first trade. On the first trade, if we zoom in, so what we are looking for, we are looking for those pin bar formations. Okay, those pin bar formations is what we are looking for. So once we have a pin bar that signals a fakey setup, meaning it was trying to actually break to the upside and then goes low, because we already know the trend is downwards. So what we then do is we enter a trade on the next candlestick. Okay, then we enter a trade, and then we set our stop above the highest candles, the highest pin bar. Okay, just above those pin bars. Above those pin bars, that's where we set our stop. So it's a very tight stop, maybe just about 20 to 30 pips away, and then you let the market run. So you forget about the trade and let your trade run. Okay, looking at the second entry. So on the second entry, we actually mark that low, new low. Okay, we mark that new lower low. We mark that new lower low. Okay, so once you identify the lower low formation, so now as price goes back up, you set your entry order there at the break of that low. Okay, then you actually have to set your stop loss around just below the consolidation area. Okay, or for a safe stop, you can even go above those wicks where we already entered. Okay, above those wicks where we have placed our previous stop on the first trade. So it's very important to identify confluence on charts, and this is our tutorial for today. Thank you. This is Philemon from FinTech Academy.